Okay, so have you ever signed on the dotted line for a loan or maybe a new credit card, looked at that shiny 5% interest rate and thought, awesome, that's exactly what I'll be paying? Well, I hate to be the bearer of bad news, but in the finance world, the sticker price is almost never the real cost. Today, we're decoding the sneaky financial math that banks and institutions literally use every single day.
Welcome to this explainer. Let's just treat this as our fun, totally stress-free survival study guide. Together, we're going to translate all those intimidating formulas and academic jargon into really simple, everyday analogies. So whether you're paying off a car, saving up for retirement, or honestly just want to understand where your money is actually going, you are absolutely in the right place. All right, let's dive into this. Here is our roadmap for today. First, the true cost of money. Second, the finance subscription. Third, present versus future value. Fourth, the forever payout. And finally, number 5, tips for daily practice. Let's get right into it. Module 1, the true cost of money, sticker price versus out-the-door cost. So I want you to imagine you're shopping for a brand new car. You see that big, bold price painted right there on the windshield. But when you actually sit down in the financing office, suddenly taxes, fees, and random add-ons appear out of nowhere. That is exactly what happens with interest rates. Here is the absolute core difference. The nominal rate is that big windshield sticker price. It's just the stated rate you see on the ad. But the effective rate? Now that determines the true cost of your borrowing. Or, if you're the one investing, it's your actual return on investment. And the difference between those two? It all comes down to a really powerful little concept called compounding. The whole thing really hinges on how frequently the bank calculates your interest. Let's look at this beautifully simple breakdown from our source notes. If your interest is compounded quarterly, your time periods, which we represent with a little n, multiply by 4, and your rate, I, gets divided by 400. If it's a monthly thing, well, n becomes 12n, and your rate gets divided by 1200. Basically, the more frequently they compound it, the more the math shifts behind the scenes. And that pulls your effective rate further and further away from that original sticker price. Now, what's really interesting about this slide is the handwritten formula straight from our study notes. Calculating E, the effective rate, is really just about adjusting for those time periods and multiplying by 100 to get our true percentage. But take a look at that fascinating little note right under the formula. It says, this formula does not require principal amount. No way, right? We literally do not even need to know if we're borrowing $100 or $1 million to figure out the true percentage cost of the money. The rate is the rate, period. Moving on to Module 2, the finance subscription, demystifying annuities. Okay, let's just completely banish the word annuity from your mind. It sounds like some scary Wall Street jargon, but it's really not. Think of it instead simply like your monthly Netflix subscription or, a car payment. Our source notes actually give us a perfectly straightforward definition here. An annuity is simply equal payments in equal intervals of time. That is the whole shebang. $50 a month, $500 a quarter. As long as it's the exact same amount on a totally set schedule, congratulations, you're dealing with an annuity. But, of course, not all subscriptions are created equal. Our notes outline 4 main flavors here. We've got the regular annuity, the immediate annuity, the deferred annuity, and the perpetuity. Don't worry at all, we're going to translate every single one of these so you know exactly how they work. First up, let's look at regular versus immediate annuities. Honestly, it all just boils down to timing. A regular annuity, which you might hear called an ordinary annuity, is when the payment is done at the end of the time period. So think of your standard loan repayments. You get to use the money for a month and then you pay. An immediate annuity or annuity due is when the payment is required at the beginning of the time period. Think of your insurance premiums or your rent. You have to pay first and then you get the coverage or the apartment for that month. And then we have the deferred annuity. This is an annuity with a waiting period where literally no payouts are happening. The absolute perfect everyday example for this, a retirement fund. You, the investor, are putting money in, but you defer or wait to receive any of those equal payments until way later, after you retire. Module 3, present versus future value, financial time travel. Now that we know what these financial subscriptions actually look like, we need a way to measure them. Because in finance, a dollar today is definitely not worth the same as a dollar 10 years from now. Whenever we're trying to solve annuity questions, we're usually trying to pin down one of 2 values. Present value, or PV, is basically a time machine bringing money back to today. It's the current worth of all those future payments. Like, if you wanted to just be done and pay off your entire 5-year car loan today in one giant lump sum, that's your present value. Future value, or FV, takes that time machine forward into the future. It asks, hey, if I keep making these regular, equal payments into my savings account, what is the total value going to be 10 years from now? Now, whether you're calculating present value or future value for these different subscriptions, look closely. Notice how you keep seeing the same key characters popping up. You've got R for your regular equal payments and I for your discounted rate. And this brilliantly illustrates how the math is really just applying our time machine concept to different subscription types. It uses that rate I to either shrink the money down to what it's worth today or grow it into a fortune for tomorrow. All right, Module 4, the forever payout. Understanding perpetuity. I know, this one almost sounds like a fairy tale. Just imagine a magical goose that lays golden eggs forever. No expiration date at all, just endless payouts. Well, in finance, this actually exists. It's called a perpetuity. As our notes define it, a perpetuity is literally a never-ending annuity. It is an infinite series of equal cash flows. A really great real-world example of this is income from a trust fund or maybe certain types of government bonds that are designed to pay a fixed amount forever. But here is a completely mind-bending fact straight from the source material. You cannot find the future value of a perpetuity. Like, it's impossible. Why? Because you literally cannot reach the end of infinity. There is no future end date to run the calculation on. Therefore, when we are dealing with forever, we only ever calculate the present value. We're really just asking, okay, how much is infinity worth to me today? And you might think that calculating the present value of infinity requires this massive chalkboard filling math equation. But look at this. PV equals R divided by I. That's it. The present value of a perpetuity is simply your regular payment R divided by the discount rate I. It's honestly beautiful that a concept as massive as an infinite payout can be solved with a formula you could literally jot down on a napkin. Which brings us to Module 5. Tips for daily practice, actionable financial habits. So we've decoded the true cost of money, we've categorized our financial subscriptions, we've time-traveled with present and future value, and we even touched infinity. Now let's turn these theories into actual actionable habits you can use. Here are 3 steps for your daily practice. Step 1, never, ever settle for the sticker price. Always ask lenders for the effective rate so you know the true out-of-the-door cost after compounding. Step 2, use the immediate annuity concept to build your wealth. Pay yourself first at the very beginning of the month, just like you pay your most important bills, rather than just saving whatever happens to be left over at the end. And step 3, use present value thinking. If a subscription or a new debt is going to cost you $100 a month for the next 5 years, stop and ask yourself what that massive lump sum is really worth today. Then decide if it's actually worth trading your future cash for. By taking the mystery out of the math, you really take back control of your own financial decisions. And I want to leave you with one final kind of inspiring thought to chew on. Thinking back to our simple little formula for forever. If you could set up a perpetuity today, what would your infinite payout fund? A charity? Maybe a scholarship or a family trust? Really think about it. Thanks for joining me on this explainer, and keep learning.